All right, let's welcome all of them on stage. We've got Kan Hee from State Street Investment Management, Keith Chan from SocGen, Eddie Lam from Direction, as well as Suk Jun Kim from Blue Ocean Technologies. So we've got you right here. Kan Hee, Keith, welcome. Eddie, and Suk Jun. All right, let's have a seat, guys. All right, before we dive in, I'm going to be getting you to help me out. Before I ask them any questions, I'm going to ask you guys a question. By a show of hands, who in this room has held a stock for more than 5 years? Who is a buy and hold investor, in other words? All right, some of you are buy and hold investors. Well done. All right, you can rest your hands. Now, on the other side, who is not that camp? Who has bought and sold a stock in less than 24 hours? In and out. All right. I suppose there are a few more buy and hold investors looking at a show of hands. Okay, so that's a good sense of what we have. A bit of a mix in that sense. All right, I'm going to be getting you guys to weigh in on some of the issues around buy and hold versus timing the market. So let's start first with Kan Hee to maybe introduce yourself as well, where you sit in this part of the market. Of course, from State Street Global Advisor, a bit more long term. Tell us more about what State Street does.
Yeah, no, thank you. And so I'm Kan Hee. I'm a ETF equities investment strategist at State Street Investment Management. And I focus on looking at our ETF equities range, working with our clients to position these ETFs, these solutions, to help them generate the best returns for their portfolio.
All right, Keith, and you handle DLCs, a bit more leverage, a bit more exciting.
Yes, so I'm Keith from SocGen. So we have listed these daily leverage certificates, we call them DLCs, on the Singapore Exchange. Yesterday was the 9th year anniversary.
Congrats.
So it's been 9 years that we've offered these daily leverage instruments trading on the SGX that tracks single stock as well as some of the indices.
All right. Eddie, you are of course behind Direction, and like the name suggests, any direction.
Hello everyone, Eddie from Hong Kong. Direction is a US-based ETF issuer, so we specialize in offering leverage and inverse ETF from broad markets to thematic to single stock. So now we have over 120 ETFs listed in the US with $80 billion under management.
Of course, on the other end of the panel, we've got Suk Jun from Blue Ocean. A very interesting end of the spectrum.
Okay. So, hello everyone. I'm Suk Jun Kim from Korea. So I'm the Asia manager for the Blue Oceans. Not many people knows about the Blue Ocean. What is Blue Oceans? So Blue Oceans provides you on 24 hours trading for US equity stocks. So especially Singapore from 8 a.m. in the morning till 4 p.m. in the morning, you can buy Tesla and sell on during your daytime. Who made it possible? Because of we and the Moomoo made a partnership to provide that kinds of Asia daytime trading services for US. You can simply enjoy daytime trading for US equities.
All right, like you just mentioned, you can trade round the clock, very different from buy and hold. So you've got a wide spectrum of points of view on this panel. So it's going to be very exciting. And I'm going to start first maybe with a bit of I guess, personal storytelling time. Kan Hee, so we talk about timing the market. What has been some, perhaps, of your experiences trying to time the market? What have been some of the, I guess, worst market timing decisions you've been through?
I think personally, the worst, most recent timing the market mistake that I made was in the crypto space during COVID. I tried to buy some Dogecoin. I bought it near $1, and it is down around 80% since. So I think that is my personal worst attempt at trying to time the market.
All right, not easy timing the market. Keith, any luck timing the market?
I mean, I I'm a licensed person working in a bank, so short-term trading is a little bit limited for me personally.
Yes.
But I've seen many investors using these leveraged products to do short-term trading, and there's one that I find it really interesting the last couple of years. So when we first launched listed products on US stocks during trading hours, Asian hours, it was some warrants on these Max 7 stocks that was listed on the Hong Kong Exchange, right? So I don't know if everyone remember that a few years ago, the Trump election, right? Trump election, and there was the Tesla trade.
Yeah.
Everyone was trading a Tesla, and so the results of the election happened during the Asian hours. So when we wake up, Asian hours market open at 9:30, and then the Trump result starts to come in, right? And then as we are seeing that he's going to win the election, we see the Tesla stock during the Asian hours is already going up, right? So if you don't look at the Asian hours, look at US Open is already gap up 12%. But 9% of that move actually happened in Asian hours. So when we first launched warrants on Tesla to trade in Asian hours, we see investors, when the Trump election as it happens, they already get into this call warrants on the Tesla and able to capture a lot of that move during the Asian hours before US Open. So that was something I think that has really changed the way of trading, especially US stocks in the Asian hours time zone.
Yeah, interesting point of view. Eddie, any stories to share, whether it's timing the market or buying and hold? What have been some of the experiences you've had?
Less for me, but I could share my mom experience. She liked to trade a lot of Chinese stock, Hong Kong stock. I think for many of the times she wanted bottom fish. So the trade would become from tactical S allocation, become a long-term buy and hold. So it doesn't work well.
Okay, that's a very familiar story for me as well. Okay, so Jun, what about you? Any stories to share with us?
Okay, before sharing my worst experience, once a day I had a talk with one of my friends who are very good at investment. So I asked him, what is your secret? He gave me a very simple stuff. Investment is very simple. What to buy, when to sell. Those are three things you do right, you can easily get the money. So my case is, the first one, what to buy. I made a very, very good decision making. Okay, space is the frontier for the investment. 3 years ago, I invested it. Then I invested that space stocks, $20. It went up and continuously it goes up $100. So I made a big right time investment. And then the stocks all of a sudden turn down, and the down. Today is becoming penny stocks. So my performance is a minus 99.2%. Now, it's just because I lost the selling timing. Timing is everything for investment.
Yeah, so I remember when I was growing up, someone gave me some advice, forwards. All you have to do is buy low, sell high. Well, of course, these days, not as easy because times are changing, cycles are being compressed. There's so much disruption when you just talk about AI. So Kani, I'm going to come to you for this question, right? Markets are moving faster than ever before. Does the traditional advice of buying an index and then going to sleep still work in this current age?
Yeah, I think it's a very topical question because markets are moving so quickly, especially this year. Broad market indexes like the S&P 500 or even the MSCI All Country World Index, they are up around 11 and 12% respectively year to date in Singapore dollar terms. That's still healthy, but on the other side you have the AI hyperscalers, the semiconductor names. These have really given, and single stocks, these have given triple-digit returns. So you really have this balancing act between, do I go for a safer index-based, broad-based investment, or do I go into a more of a high-octane, high-octane targeted exposure? And I want to touch on two things. I think one is risk tolerance, I think we mentioned, and the other is investment horizon and timing. which Seokjun mentioned as well. So risk tolerance is essentially, how I see it, is how high are the highs and how low are the lows. We call this volatility. How volatile is your investment? And you tend to see broad market cap indexes be less volatile because they have a diversified sector base, they have diversified names, they tend to have more holdings, more different types of holdings within their portfolio. The second thing is timing. Timing is so important. So we've seen a little bit of a rotation away from the AI theme in recent weeks. I think global semiconductors since June 19th are down around 11% as of yesterday, whereas the S&P 500 is actually up 0.62% in Singapore dollar terms. But then if you look back at year to date, if you had invested at the start of the year, you'd be up 47% for your global semiconductor exposures. So really timing is so important. You need to define how long your investment horizon is, or how short it is, to then balance that act of, do I buy and hold into a broad market cap index, or do I go for a more targeted exposure for a shorter time?
All right, nice one. All right, Seokjun, let's get you to weigh in on this. Are you completely on board with what Kun just mentioned? What's balance look like to you? How do you strike that balance when you talk about timing?
Yeah, on the timing perspective, as a Blue Ocean is as a kind of investment infrastructure provider. So we are focusing on the timing on position balance and also the easy market access. That is very important on our side. 2 years ago, the Singapore citizen, Singapore investor, when they hear kind of bad news impact on my US portfolio, they have no way to cover. Just to sit back and wait until midnight, US time opens, then it's too late. But these days, through the Moomoo, you can have all-time US access. So whenever you hear any bad thing impact on my US portfolio, you can easily rebalance your positions. So I really want to remind you, you have 24-hour access environment for US equity trading. So Moomoo platform provides a full functionality. Just to enjoy it, leverage that functionality to make your investment profitable.
Yep, so lots of information is accessible right now. I think that goes to Eddie's domain as well. You have so many opportunities right now. Where do leverage products fit in when you talk about timing?
So I think as investors, I agree that strategic allocations is key as a starting point. Having said that, the market is so different compared to 20 years ago because of the AI developments, all the geopolitical events, information flow, the speed of information flow. So that drive all the market right now could move very quickly in a short period of time. So I think that's where tactical asset allocation play a role. Say by using leverage product, you could basically get a precise exposure. And second, you could by investing in leverage product without using a margin account. But definitely the key is the risk management. I think so for most investors, long-term buy and hold strategic portfolio is like your main course, and tactical asset allocation, short-term trading is your seasoning.
Okay, so Keith, I'm going to get you to weigh in on this as well. And this is where I want to get help, because not everyone wants to be totally passive. They want to be nimble to some extent. So let's talk about how you can use structured products as part of that mix. How does that let investors custom build their exact level of risk versus reward?
So when you talk about structured products, in terms of looking at the risk, there are mainly two things, right? One is really the risk coming out of the product. So you really need to study, different scenarios, how that will affect the value of the instrument. So let's say for DLCs, pretty a straightforward kind of structured product. It gives you the daily leverage return of the underlying stock's performance. You have different leverage levels, like 3 times, 5 times, 7 times leverage that you can choose from out of the instruments. So one is the risk coming from the product. The other is the risk coming from the underlying security, right? So every stocks, every sector, they have a different volatility, right? Some of the US stocks, especially these days, with semiconductor stocks, AI stocks, can one day change 5%, 8%, 10% move, right? So if you have a volatile stock, how you use a leverage product will be quite important because leverage product obviously will magnify the underlying move. So if the underlying volatility is high, you should consider either looking at some lower leverage instruments or maybe reduce your capital to get, to have the right exposure, right? Versus maybe a structured product or DLC over index, right? HSI, HS Tech is one of our star products. Index, obviously, the volatility is much lower than single stocks. And that's why for index instruments, we can look at some 5 times leverage, 7 times leverage. So I think the interesting with trading these kind of listed products, structured products, you really need to obviously do some homework to understand the risk that comes out of that product. But also you have to have a good understanding of the underlying securities, right? Because every stock, every index can move very differently as well. Yeah.
That's a very good point about risk. Eddie, maybe you can weigh in here when you talk about leverage and inverse products. When does it become genuinely useful and cross the line to become dangerous? How do investors navigate these products?
Yep. So before investing in leverage product, I think first you have to understand the risk. I think Keith just now shared a bit the risk of DLC. I mean, leverage product has some similar risk because it's embedded option and it's a leverage product. So especially for investors, they have to be aware of the daily reset, compounding, and volatility drag if they hold the product longer than a day. So if you hold the product through the cycle with high volatility, you will be suffer on the investment capital. So I think first one is you need to, apart from the conviction, you have to have an understanding on the underlying instrument. I mean, second point is the sizing, the position sizing. Given strategic tactical allocation is short-term trading, it wouldn't be represent like 50-40% of your portfolio. To start with, maybe start with 5% to 10%. I mean, the last part is the risk management. So before you enter the trade, you have to be aware of that. Sometimes the direction is not work on your direction, expected direction. Then you need to have a stop loss mechanics. So you need to follow the risk management to do the stop loss. So I think that is very important, especially when it comes to tactical trading. Understand the risk, put a position, right position sizing, and then you should have a risk management as a framework.
Yeah, so risk management, so actually very interesting for Blue Ocean because you now offer the opportunity for investors to react at any time to news events. So they have the opportunity to kind of hedge against risk events 24 hours right now. Is that what you're seeing investors do right now as they are able to become more flexible in this current landscape?
Okay, on that one, yes, Blue Ocean is a kind of exchange, so we are providing the very good liquidity. So what we can do, or what I can say, is that the trading from the Asia takes a big part of the whole liquidity. Some is doing the very passive investment purpose, and some is unbelievably active investment behavior. So all those kind of daytime trading on our platform, we clearly see various different kind of trading. So the timing and the passive and the active and the strategic one, and also the risk endurance is the very important on the investor side.
Okay, so it sounds like we need to find the right mix to strike that balance. Queen Hee, there's this idea or framework about core plus tactical. So if we use or treat passive ETFs as the core, what should then be the percentage when it comes to tactical for other things, like things you can use to move around more nimbly?
Yeah, I can't put a percentage, I think it really depends on the risk tolerance that an investor has, that everyone in this room has in terms of making these active bets. But what I want to share is that if you have ETFs that track broad indexes like an S&P 500 or a MSCI All Country World, you're essentially saying that you think the market is efficient. You're saying that the market is efficient and you're happy to let the market capitalization do its thing. So by taking tactical bets, you're saying, okay, I feel that I can find some opportunities, some alpha on top of the market where I think this will contribute to me beating this benchmark. So it really depends on the risk tolerance of the individual. But as a range, I would say from 0%, so there are investors that only want to hold core broad ETFs, to around almost 50%. So they want to invest half of their money into these more active and deliberate tactical bets.
Yeah, sounds like there is that balancing act. Keith, let's get you to weigh in on this. What is perhaps a common mistake where investors try to mix both long-term as well as a more tactical approach? Is that something that they need to be more mindful of?
Sure. I mean, so obviously I think most investors will have their core stock holdings, right? And one of the things is how you can use like a leverage or inverse product like DLCs to kind of either do some risk management, hedging, or increase exposure to certain stocks. So I think when it comes to leverage, a lot of people, when you say leverage product, too risky, okay? So, but how I would say to that is, it's risky, depends on how much capital you put in it, okay? So let's say if I'm planning to invest in a stock, right? Let's say I want to put $10,000 to buy a stock. I have a 5 times long DLC on this stock. So if you put in 5 times less capital, let's say you put $2,000 on a 5 times long DLC, your exposure is actually the same as $10,000 in a stock, okay? The mistake a lot of people make is, I have $10,000, I want to buy this stock, but I'm so bullish, I want to get more return. So I use $10,000 to buy a 5 times long DLC, then your exposure is $50,000, okay? That's a different risk, okay? So when you trade leverage products, actually how you can, first you need to understand the risk and how you can control this risk, right? And how the way you control it is actually very simple, like it's how much capital you put into it. High risk, low capital, right? Then you will be more comfortable, and maybe this instrument can really add extra return or give you a bit more capital efficiency in your portfolio. Or let's say I want to diversify into other stocks instead of, for a short-term period, instead of putting 100% of capital, maybe put 20% capital on a 5 times leverage instrument. That's how we can have a bit more efficiency on your capital, right?
All right. I talk about a portfolio split, Eddie. So someone might have a portion that's maybe safer and another portion that's more aggressive. How do they make sure that the aggressive part doesn't overwhelm the safer part? What is your guidance on that part of the equation?
So going back to this, as I mentioned, like the investment process is extremely important. So definitely you have to have a conviction, you understand the risk, portfolio sizing, and then you have a risk management. I think one thing, apart from calculating all the risk, if you do the tactical short-term trading, if the trade went wrong, if you couldn't fall asleep, if you get stressed, then you have to reconsider maybe this approach is not suitable for you. So either you should cut back your position or do less short-term trading in the future. But I think the good thing is for now, because of the AI, I think Moomoo have a lot of function. I mean, for a lot of investors, they could basically implement some sort of like risk management so that you could have a more disciplined approach when it comes to tactical short-term trading.
All right, thank you, Eddie. All right, quick one. We are going to be taking questions as well on Slido.com. If you have any questions for the panelists, this is where you need to go. You can scan the QR code or go to Slido.com and key in 3106987. Keep your questions coming in. This is where you can ask our panel of experts your burning questions, and it's a great chance to also find out how to navigate the markets right now. And talk about navigating markets, I think an important part is knowing who you are as an investor, what type of investor you are before you can find the right strategy for you. What's your advice, Connie, when you're trying to figure out what is the best approach? What works for an investor? When does buy and hold work? When does timing the market work? What works for which investor?
I think the fundamental difference between a really passive investor, buy and hold, DCA investor versus a really active investor is essentially the time that you can spend monitoring the markets, monitoring the companies, monitoring trends, monitoring macro, monitoring policy. So it's really time that you need to invest to make sure that your active bets, that your active exposures, are of sound foundation. So the time, that you can spend, I think, I don't know how much.
Right. So
how
if
many
both of us
people,
are the same age, if I'm too lazy and can't be bothered reading the market news and all that,
I mean, like
it's not an age factor, right?
Yeah. If you're a working professional, you're tired at the end of the day. Do you have time to monitor the U.S. market overnight? Maybe not. So I really think that time is a very key component to understanding how well you can monitor your investments.
Yeah, how much time do you spend watching the markets every moment? I think that's a very important consideration. So Jun, from your experience, how does an investor figure out what is the right mix when it comes to buy and hold or timing the market using instruments that are available through your platform? How do they figure out what is the right approach for them?
Okay, so we analyze the trading trend in our platforms during the day. Most of them, a lot of portions is coming from Asia. So our product classifications we found is that the 50% is for the normal stocks. Another 30% is on the ETF side. The remaining 20% is on the penny stock. So non-traditional symbol, which is the ETF and the penny stock, is very, very popular, especially for Asia, which tells us a lot of Asia retail investors really love high risk, high volatile products. So it makes us thinking that the Asia trend is getting more active and aggressive investment these days. Of course, the mutual fund investor, buy-side investors still keep the buy and hold strategies and the long-term passive ETF, but the individual customer is more focusing on the active and the aggressive strategy, especially, as you know, the Asia retail investor is very, very aggressive. They really love the high leverage ETF listed on US. So that's why a lot of Korean guys focusing to trade the US equities and the ETF, something like Kospi stuff. Daily trading many times. That is very active. That is what we see as across the Asia customer base.
All right, talking about trades, Eddie, what is the prerequisite to become an active trader? How much emotional discipline do you need to be an efficient or even successful active trader?
It's not always easy. Definitely, first of all, you need to have conviction. You have to monitor the market, what's going on. You need to have a risk discipline. Definitely, I think investment is part of the science and art. You need to like it. If you want to be a short-term technical trader, you have to like to monitor what's going on. I think that's the part of the very important factor that you become a more higher chance to become a successful short-term trader. But I think one point I want to say is that apart from taking more risk Actually, we see that overall the investor are getting more sophisticated. So leverage and inverse product, we do often see that, but the market reached the historical high, like semiconductor. So sometimes we see investor actually invest in the inverse product for hedging. So I think the good side is people are more active because there are more tools to use, but at the same time, they get more sophisticated as well.
All right, so that's a very good take on emotional discipline. Sometimes it does feel like riding a roller coaster every day, sometimes even because headlines are just coming in. Okay, let's take a quick look at what we have in Slido as we get in more questions from the crowd. A lot of questions as you try to navigate some of these interesting points of view. There's one, what is your view on the upcoming potential financial crisis? And what is the best advice to prepare for it? I guess it's a very interesting question by itself. Do you guys see one on the horizon, a financial crisis? Keith, is there something that worries you that might go wrong in the financial system? Are you seeing a slowdown, a recession somewhere? What is the top risk event for you right now?
Yeah, well, I think obviously these days everyone is, a lot of money and flows are into these AI semiconductors. Everyone look at the capex spending of these companies and how these monies are spent and benefiting all these semiconductor stocks, right? So I think a lot of the markets looking at, let's say, upcoming earnings, whether they're seeing the return from these capex. But all these things are obviously is going to cause a lot of volatility in the market. And then behind that, there's always the geopolitical issues with the war, with the oil price, risk of inflation. So there's really a lot of things going on. So I'm not a fortune teller. I can't tell you about financial crisis, but for sure, I think volatility is going to remain. And how you can spend the time to understand other products, leverage or inverse, or these instruments that are trading in different exchanges, and how it can complement your portfolio holding, whether it's to hedge, as Eddie was saying, that can reduce some of the risk, downside risk, or to diversify with limited capital using a bit of a leverage instrument to kind of ride this volatility through, right? So that's how I would say, it's quite important.
I reckon, Heath, from your point of view, we see markets hit new highs every other week. Is there a sense of maybe complacency right now in the markets? Is that something that worries you?
I think it's something that investors are looking at, but if you look at the fundamentals, they are quite resilient. If you look at the fundamentals of the companies, the earnings, inflation, job reports. So if you look at these data points from, referring to the question, a potential financial crisis, I think, we're quite a bit away from that. I understand, as Keith mentioned, there is a lot of volatility. There is a lot of volatility at the moment, but that is, I think, very different from a financial crisis where that's a very systematic, a broad thing. So if you look at the economic measures of the developed markets, also the emerging markets, the fundamentals are still quite strong.
All right, sounds like a very optimistic tone so far. And thank you so much for the questions that have been coming in. I'm going to wrap things up right now and ask each panelist for their single most important takeaway for any investor leaving MooFest today. And I'm going to start with Suk Jun first. What's one takeaway you want people in the crowd today to internalize as they go for the next trading session?
Okay. I have one message. US market is at your hand. You can access anytime trading through Moomoo applications. So you can deal with US equities and ETFs exactly the same way like SGX. So US exchange is not the alien exchange anymore. It's still like a local exchanges. The technology made it realized. So enjoy it. Enjoy the technology, enjoy the environment, enjoy the functionality.
All right,
That's
the
my
playing
message.
field has leveled to some degree because of these options. Eddie, what is your takeaway for the crowd today?
Investment is a lifelong journey. Keep learning, plan your trade, trade your plan.
Very nice. Eddie, what's one advice you have for the crowd who may be thinking, what's the best way to tackle markets next?
Yes, so I hope one thing you can remember is that if you want to trade US stocks or index, you can also trade it on the SGX via the DLC during the Asian hours, because a lot of people doesn't understand, but a lot of people are trading US market, right? But of course, I think one important advice is, of course, when it comes to leverage trading, the discipline is important, all right? So always, set stop loss, take profits, set targets, and really be disciplined in trading and manage your capital efficiently. Yeah.
All right, discipline important for traders and investors. Kun-hee, what's your takeaway?
I don't think passive and active are two different things. I think you can be actively passive and passively active as well. So using the tools and the number of products that are available through the Moomoo app, I think that is the key takeaway.
All right, very nice. Time in the market, of course, or timing the market, that's a big question. After today, I hope all of you have a clearer view of where you sit and more importantly, why. So it's important to understand who you are as an investor. So the answer, of course, different for everyone, but one thing that everyone on this stage agrees on is that investors who succeed are ones with a plan, the discipline to follow it, and the tools to execute it. So once again, thank you to our panelists, and let's give them a round of applause.